Fantastic. We see some people coming in. Good morning, everyone. Good afternoon, depending on where you are in the world. We're just going to give it a minute or so to start letting everyone in. We've got quite a decent amount of people coming in. Lovely. It's going to be a great webinar. How's it, Graham? You doing well? Thanks for joining us.
Hey, thanks, Renier. I've still got a bit of a scratchy throat, so if you see me sipping from my cup here, it's not a glass of wine, it's some good old-fashioned rooibos tea. So looking forward to being here.
Fantastic. Excellent. I'm just going to give it a few more seconds. We've got quite a few people joining in. Lovely. Hello, Mandy. Hello, Gemma. Hello, Neil. Good to see you guys here. Fantastic. Guys, we'll go through the itinerary now and just look at the Q&A, but let's kick it off. Everyone, thanks very much for joining us at one of the Connect Communities webinars. We've got the great Graham Stephan in the room with us. He's CEO of BizVal. It's one of the companies that we've been dealing with for quite a bit of time. I've known Graham, I think over a year, Graham. We met at a networking event. I think it was Caleb's networking event that we
I
met
think
at.
that was right. It was up in Cliff Street. I think that was probably a year and a bit ago. I mean, time flies.
Yeah,
I think
indeed.
you've got it married in between, and
This is true.
my kids have become teenagers. So lots happened in the interim.
And this is the power of just going to these events. You meet some awesome people. So, I met Graham. We did some business with Graham. And earlier in the year, we went through this evaluation kind of process because, we've been building this business for over 13 years now. I actually don't know what we're valued at. And it's not to say that we wanted to go and sell it or, get investment in. We just wanted to know, what our business is worth and where we need to be going, because we all have a certain figure as founders to where we want to potentially exit, or if we are going to exit in the future, what does that look like? Maybe there's a few things that we need to actually attend to now. So, I went to Graham and his team at BizVal. They gave us this amazing service to actually value our business. So I wanted to do a webinar to show you guys a bit of value as to what you should be looking out for. We're going to go through a few tips and tricks that Graham wants to give us. This is completely free advice, free value that Graham's going to give us, and maybe you can use it within your business. So really excited for this. Graham's prepared us a lovely presentation. I'm going to hand over to him. He's going to share his screen. And if you do want to ask questions in and out, please do so. There is a Q&A and a chat at the bottom. I'll be going through some questions probably at halfway point and then taking it from there. But no questions off the table. Please do ask that. And yeah, let's kick into it, Graham. Fantastic. Go for it.
Fantastic, Renier. Thanks for having me, and thanks to the Connect community and everyone from FTC. So really wonderful to be here. I think it's not often you come into a webinar where there's this kind of weight of expectation. You guys are great at marketing and building things up on LinkedIn. I guess that's part of your expertise, right? So I feel a little bit under pressure today, but hopefully we have a good chat, and let's keep it casual.
Fantastic.
If there's any comments or questions, feel free to jump in. So
beautiful.
We're going to talk about building a valuable business and talking about valuation today. And I'm just trying to make sure I can click through the slides here, which there we go. I'm not going to talk about myself. My background is we've been running BizVal for the last 2.5 years, but we're really passionate about helping entrepreneurs unlock the value in their business. I always tell the story that my dad was, is the nicest person and the best mentor I could ever have had, but he's not a businessman. And for the last 30 years, he's been self-employed out of choice, but hasn't built a business. So at 74 years old, he's still climbing up ladders and keeping himself busy, but he doesn't have a retirement nest egg. So I didn't want other entrepreneurs and other founders to kind of fall into that position. If he wanted to keep working, great, but he doesn't have the option. And I think that's one of the most important things to realize about building a business of value. It's not necessarily about selling. It's about having choices and having optionality. And that's one of the things we talk about. So what are we going to cover today? So I want to touch a little bit just on the importance of business valuations, why they're important. Building for value from day one. It's not something you wake up one day and say, hey, I'm going to sell my business, and click a switch and your business is sold. So that's important. We're going to talk a little bit about the sort of theory and the principles around business valuation, some of the methodologies. I'm going to touch on sort of high growth businesses versus small and medium, typical small and medium businesses. And I'm not going to dwell too much on this, but we often have the discussion around, but I'm a startup, I'm a high growth business, I'm different. So I just want to point out some of the key differences, but also where some of the similarities are when you think about value. And then we're going to talk, around the value drivers and detractors. So valuation itself is nice, but actually knowing what are the levers that you can pull to make that better is more insightful and more important than the actual number itself.
Most
So
definitely.
we'll spend
Most
a bit
definitely.
of time around that.
I think just to give some context there as well. I mean, when we went through this process and getting the business value, just to understand what equity we built, because we're on this train, we're going, we don't know how big the train's become or how valuable it is really, because we entrepreneurs, we're in the business, we're building, there's a lot of problems that we're facing on a daily basis. And it's lovely to get to a point to say, right, this is the benchmark of where I am at the moment. And I think going through the question and answer kind of thing, identifying problem areas in the business was exceptionally valuable, because it helped me in the last year make some very, very key decisions so that we didn't spend the money where we shouldn't be. And then we started focusing where we should be from a value perspective. Because even if we don't want to sell, we want to build a sellable business, because that helps you focus on your EBITDA, your profit, your OPEX. It helps you look at all the key figures that actually makes a business sellable and valuable. And you want to make sure that it's not a business that just eats profit and revenue, and you sit at the end of the day with an unvaluable business. So I think for us, it was an exceptionally great and valuable process to go through. So that we know we're starting here, we are kind of 10, 13 years down the line, but now we know the next year, what does it look like? Have we grown? Have we not? Where have we grown? Maybe it's got more profit. So that's where we came in from a context side, and it helps us with that information. But let's go for it.
Spot on. Yeah. And, I just want to touch on something about that. For us, it's always about the entrepreneur being at the heart of everything. But interesting, like positional shift we made, and we kind of realized this. There's one thing about knowing your value, and it's another thing about being investable or being exit ready or sale ready or whatever it is. And the two are interlinked, but not necessarily the same thing. And we've even made sort of a subtle shift in our positioning. You'll see our little tagline now. It used to be know your value, and now it's get investor ready. And it's because it's at the heart of this is you've got to talk to the why you're doing something, not just what are you doing. But I'm going to dive right in, and I think the first point is around, like, why do you need to understand the value of your business? And, to quote Stephen Covey, who I'm a big fan of, so hopefully we don't lose half the audience now. But one of the things he talks about is sort of the quadrant of important versus urgent things. And typically, business valuation is often like, it's in the quadrant of it's important but not urgent. So people don't do it because it doesn't give a real value there and then, or they don't think it's going to give them a real insight there and then. So it's like your health, right? When you're young and fancy free and you're running around smoking, drinking, whatever you're doing in your early 20s, you're not thinking about how's this going to impact my life when I'm 65 years old. Will I be able to even climb up the stairs, for argument's sake? So we like to think of it in those sort of contexts and those pictures. But I think when people think about valuing a business, normally they think, I need to value my business because I want to raise some money, raise equity, or I want to sell my business. And that's the wrong time to start, in actual fact, because it's too late. You don't wake up and decide, you're going to sell your business and it happens tomorrow. Usually it's a sort of 12 to 18 to 24 month process to actually get sale ready. So we're going to talk about some of that stuff today. But more importantly is actually what I call the sort of managing for growth. And Renier, this is where we've worked with you specifically, is around using evaluation as a metric to manage your growth and manage how you're executing against your strategy. Now, in the listed world, listed public entities, how are CEOs of businesses managed? How are they rewarded? How's their performance determined? It's by reference to the share price. Now, in a publicly traded market, it's easy to see what your share price is at any point in time. The company's doing well. The CEO gets big bonuses because the share price goes up. Now, in private businesses, valuation is nothing more than a way of determining the share price of that business, and looking at it
Love that.
through a lens of not just short-term profits, but a longer-term view. So that's really kind of the key point around why evaluation is important, to help you understand that and make better long-term decisions. Now, I don't know if you know this, but I mean, one of the stats is that 85% of private businesses never sell. They just end up being shut down, closed down, all of those. And that's a scary stat. So, the sooner you start, 30, 40 years ago, people didn't know, I don't know, that a bad lifestyle led to early heart disease. Now we do. Okay, so you go and you get a cholesterol test done, and you do it regularly. So it's a very similar sort of notion that we like to think from a valuation point of view. I'm not going to go through all the details. Yeah, it's a health check.
It's a vitality health check, if you had to call it that, to go get your metrics done, so that you know how well you've done for the year or how badly you've done.
100%. So hopefully your discovery age is lower there for those not in South Africa. But I mean, if your discovery age is lower than your actual age, then you're happy. If it's a bit older, then you've got some work to do, right? 100%. So I think let's just understand how evaluations work. Now, at the end of the day, there's this principle of willing buyer, willing seller. So if somebody's prepared to buy something, you can sell something. That's actually how the markets work and how market price is determined. But that underpins all of that is really sort of two key principles, and I'll go into that now. It's a function of risk and reward, and it's a function of how certain the future cash profits from that business are. Now, there are exceptions. People are going to say, well, what about the brand? What about all those sorts of things? But simplistically speaking, if you come back to first principles, it's about how much profit is this company making, and how much profit can it make into the future. When I say profit, I mean cash profits. And how risky are those cash profits? It's as simple as that. Now, I don't want to overcomplicate it, because a lot of people think, I can't think about valuation because it's this mysterious, dark, black box kind of thing. The reality, it's not. And if you understand the principles, then you can influence those. So yes, it's a craft, as I like to say, and a science. There's no absolute right answer. Is Renier's discovery age 28.5 or is it 40? Well, it's probably between 28 and 32 or somewhere around about there, depending on who you ask. But, at the end of the day, it's the range that's important. I want to just touch on 2 points around startup businesses, because startup valuations can be tricky. The principles for valuing a startup are the same as an established business. But when you talk about these sort of unicorn valuations and, somebody's raised money at X million dollars, okay, it doesn't mean the company is actually worth that. And the reason for that is twofold. I just want to touch on 2 points. One, for startup businesses, investors, particularly early stage investors like angel funders or VCs, often look at this as an option. They want 1 in 100 companies to hit it big. So they apply what they often call option pricing to evaluation. And they look and they say, well, how much money does this business need to get to the next round? And can I sell it? Can I sell my stake at the next round for whatever that valuation or that share is? So that's one of the things they look at. And often, early stage investors will also, they're professional investors. So there's also things that go beyond valuation. Often they'll seduce naive founders and first-time founders with, there's this huge valuation. But hidden in the T's and C's, often in some of those contracts, are things like what we call preferred returns, shareholder dilution. And I just want to touch on that, because a big valuation in an early stage startup doesn't actually mean that the founders are going to get that number down the line. So
interesting.
I'm not, that can be a whole webinar on itself, but I just want to flag that, because I know your audience has got a mix of, existing business owners, new stage guys. We're not going to dwell on startups, but the principles are the same. Okay.
Fantastic.
So I'm going to talk about some basic principles here in terms of building a business of value. And as I said earlier, understanding what makes a business valuable, there's nothing complicated or complex. A lot of the stuff is about just knowing what to focus on. And I'm going to talk about these sort of five key principles over here. Owner independence, effective scalable processes and systems, strong unit economics, a robust understanding of customer, and that means a whole bunch of things, And is the market sufficient to achieve a desired outcome or investment outcome? So these 5 things are sort of the cornerstones of thinking about how do you build a valuable business. First off, if you look at a business through the lens of an investor, nobody wants to go buy a job. They don't want to invest in a business and then go and have to work really hard. And a lot of businesses, particularly smaller business, owner-led businesses, have what we call owner dependence. So they're very dependent on the owner. In fact, with our stats, I mean, we've valued hundreds of businesses over the last few years, is less than 6% of business owners. If we ask them, can you take a 3-week holiday and leave your cell phone behind? Less than 6% of business owners are able to do that. Okay, now that's a scary stat, and Renier, I'm sure you can relate to that in some ways of building FTC. Yes.
Yeah. I mean, I'll give experience share. When we went through this, that was the one question. You know, can you go on holiday to Thailand, not take your cell phone and laptop, and the business will still run? And my answer was no. You know, I'm still very, very much involved from a payment and sales perspective. And it made me very aware as to the areas that I need to now start outsourcing, getting people in, handing over, so that I can go and do that 2 or 3 week. And that's a good litmus tester. Can you actually go take a 2-week holiday without the business being affected? And I think if we are going to get into the position of talking about sales or mergers or strategic buys, you can't be the bottleneck. You can't be that owner. And it takes many years to not become that. It might take 10 years, might take 15 years, might take 5. I don't know, depending on how quickly you can get that done. But what it's done for me now in the last year is I've been able to now hand over a lot of the stuff that I would normally do on a daily basis, and then focus on the business as a whole and making sure that we have the inflow of business, but I'm not doing the daily kind of stuff. But it made me very aware of that, because I couldn't take a 2-week holiday going into it. And if someone buys the business, they obviously, yeah.
What I find quite interesting, it was only a few weeks later, and your fiance or girlfriend of 10 years managed to get you to take a 2 or 3 week honeymoon. So maybe there was an added benefit to that question. Jokes aside, but I think that owner dependence and that mindset is important, because you can't do that when you've been running the business like that for 35 years, suddenly wanting to change it. So the sooner you have this mindset of around, how do I build a business that's not dependent on me, the better. That then, I guess, leads into the next point, is around effective, scalable systems and processes. So part of the how you do in owner independence is around building processes and systems. And that could be people doing the job. We hate talking about documenting things, but if somebody's buying your business, they want to be able to see, how does the business actually work? Or if somebody's investing in the business, you need to be able to articulate how things work with you. One of the biggest challenges here, and most businesses suffer with this the most, is the sales function often sits with the owner. And it's the last to leave, the last to hire a sales team, because you don't want to pay the sales guys these big commissions and what have you.
I'm literally that. That's literally our case. Yeah.
Yeah, and that's really hard to do, because you're passionate about your business, you're passionate about your product, you can sell it better than most, but it also forces you to say, if somebody else is going to sell your business, you have to think about, how do you make your product simpler to understand, easier to resonate with consumers and all those good things. So again, I'm not going to go into too much detail, but understanding how to build effective and scalable process systems, and having somebody who can guide you along the journey is absolutely critical. So I know, Renier, you've worked with some other partners of ours, the guys from Core BSA, for argument's sake, who have been, let's call it, fractional CFOs, advisors who've helped you implement some of those things. So
Correct.
You don't have to do these things alone, and having people who have done this for a living and with other clients and had the experience is really, really important. The third point I want to talk about is sort of strong unit economics. It sounds like a fancy MBA term, but this basically means, are you charging enough, and are you making enough profit off every single sale that you make? Because the fastest way to bankruptcy and not to have any value, and then the best companies in the world are able to maintain strong unit economics. If you look at Apple, everybody complains about their pricing, but Apple is successful because they've got strong unit economics. They're able to convince customers to pay a lot for, they could get a Samsung or another product for a lot cheaper, but they've got strong unit economics and they built the brand and they built everything around that. So understanding, are you making profit on every single engagement that you're making? If you're making losses on certain clients, are you over servicing them? If you're a service-based business, understanding what those unit economics are so you can make conscious decisions around those are absolutely critical if you want to build a valuable business. I want to touch on one thing here, and it kind of leads into the next point, and that's about understanding who your customer is and what problem you're solving for them. So it's one thing having strong unit economics, but it's also around who are your customers, who are your good customers, who are the guys who, what are their real needs? How are you evolving and adapting? And Renier, in your business as well, the landscape of digital marketing, the landscape of LinkedIn and all those sorts of things has evolved over the last 3 or 4 or 5 years. And if you hadn't moved to kind of understand how that was evolving, pre-COVID, post-COVID, you wouldn't have a business. So you have to be able to accept that it's not a static point in time and you need to keep moving and looking at that. And when an investor looks at your business, they look at the owner's ability, or the management team's ability rather, to be able to understand the customer, respond to those needs. I want to touch on 2 things that make a big impact here. The one is, when you start a business, often you have 1 or 2 big customers who kind of get you going. And that becomes the noose around your neck when you want to have a valuable business, because you have what we call customer dependency. Like owner dependency, 47% of businesses we look at are reliant on 1 or 2 key customers that if they lose those customers, they're no longer profitable and they effectively will go out of business. Okay, that's a scary
risky,
stat.
That's scary.
1 in 2 businesses. Okay, so you have to be thinking about, how do I build resilience in my client base? And then the second point around that is what we call annuity income. So a lot of businesses sell widgets. They sell one, customer goes back. How do you get that customer to keep coming back? Subscription type models, Renier, that's something, again, we've spoken to and looked at about you. Annuity income means that somebody signs up. Netflix is a great example. You sign up, debit order goes off in the background, and for the company, that money comes in every month. So understanding, how do you move your business towards an annuity income model, or at least a portion of your income to be annuitized, is a huge value driver. And then the last thing I want to touch on quickly is just, is the market big enough to actually get the desired outcome? So there's nothing wrong with having a niche business or a small business, and it's a conscious choice. But this goes back to the sort of startup thing again, is if you've got an idea and you want, your number is this $1 billion number, you have to look and say, is the market big enough to get that? Now, this is where we sit in South Africa. South Africa is quite a small market in the global context. But I encourage business owners to think about it differently. If the market in your area is too small, think about, how do you reach a bigger market? So flip that question on its head to say, how do I get to a bigger market so that I can deliver my service well? What tends to happen in small markets is people say, well, I need to do lots of different things so that I can make ends meet. That's actually not the way successful business people think about it. They rather think about, how do I grow a bigger market, maybe in another area, another jurisdiction, so that they can remain focused on delivering that 1 or 2 value propositions really well. So, maybe I'm talking to South Africans in the room. Yes, it's good to have fingers in different pies, but you're going to struggle to grow massively,
most definitely,
unless you're able to do that.
I think when we went through this, our market size, when we went through the whole process, was a 9.8 out of 10, meaning it's infinite, right? Because we work in a service-based business, we're working with clients all over the world. There are millions and millions of people that could use our service, and we would never be able to go through it. And even if there is 1,000 competitors, it would never diminish the size of the market. And I didn't know that. I went going through the whole thing, realizing actually it's infinite. We have an infinite market to service. We can only service 100, 150 clients at any given time. So it was a fantastic little thing to know. And as an investor, if they had to invest or purchase the company, knowing that we don't have a limit to who we can service, it is unlimited at the moment. And that's a great thing to know going to any conversation and any growth that you want to do in the future. Yeah.
Absolutely. Okay, I'm going to just spend a couple of minutes on this very quickly, and I'm going a bit technical again after doing quite a sort of strategic discussion, but I want to just very quickly talk about what we call the multiple, okay, and the revenue multiple.
Yeah.
This is when you talk valuation, you'll often hear friends or colleagues or people saying, well, what is your multiple that you're trading at? So in other words, it could be a multiple of revenue, or it could be a multiple of your profits. And basically it says, if you take your revenue or your profits and you multiply it by a certain number, that gets to your value. Now, that is a proxy. And I just wanted to say, beware what we call the revenue multiple. Okay. Because people will say, my revenue is $1 million. Their revenue was $1 million and they sold for $10 million. Therefore, my business must be worth $10 million. Okay. Now, you can have two completely different businesses, one with $1 million revenue and $500,000 profit and growing at 30% a year. And you can have one with $1 million revenue, no profit, and the market is contracting by 10% a year. There's no ways that those two businesses are worth the same in anyone's language. Okay. So when you use things like multiples, it's a quick check. The analogy I always use is if you had to, and we South Africans, so I'll use a South African analogy. If you had to put 5 6'5", 120 kilogram men in a line, you can't by inference say they all play rugby for the Springboks, okay, in the front row, be it at that. So when you use multiples, exercise them with caution. They should always be used in conjunction with another valuation method. That's all I want to say on that. It's a bit of a technical point because people get hung up on this, and it's not complicated, but you need to understand the limitations of using multiples. If you're comparing two very similar businesses, similar size, similar jurisdiction, similar region, fair enough. But you can't compare a multiple of a software as a service business in the United States versus one doing a very small niche in KwaZulu-Natal in South Africa, for argument's sake. Okay.
Sorry. Yeah.
So again, I'm not going to dwell on this, but we look at 3 key valuation methodologies. Now, when you understand this, I spoke about what we call the discounted cash flow. This is essentially what I spoke about earlier. What is your current profit? How do you grow that? What's the growth rate? And what's the discount rate? Now, the discount rate is an inverse relationship. The discount rate says, what is the required rate of return that an investor would want in your business? So if you go and you put $100 in a bank account, what would you expect to earn in interest? Okay, 5%, 3%. That's low risk. If you go and take $100 and you invest it in a business, there's risk attached with that. You might want a 20, 30, 40% rate of return. So the higher your rate of return that you require, effectively the lower that the business is going to be valued at. Okay, so it's an inverse relationship. So a discounted cash flow basically says, what's the profit? What's the expected future profits? We discount that back in today's terms, and that gives you a value of your business. That's one method. The second is what I spoke about, the earnings or the multiple method, where it's says, let's look at similar businesses and see what they trade at. And the last is what the accountants typically refer to as the net asset value method, is you add up all the physical things that you own on your bank statement, on your balance sheet, your property, your cars, your equipment, and you deduct any of the debt from that. Now, typically that would be used in the situation where a business is being wound down or liquidated. Certain industries like mining, for instance, where you have lots of equipment and machinery and that, you might apply that. But these are the 3 basic valuation methodologies. There's probably 50 methodologies, but they're all an iteration or a variant on one of these 3 methodologies.
Yeah, most definitely. I think just go back to that one slide. The one key thing to know here as a business owner is your beta. Now, your beta really is a little metric to tell you how healthy the company is doing from a profit perspective.
EBITDA for the accountants. You're giving away,
EBITDA.
West accent.
Sorry, my bad. I'm actually going to get a coffee mug with EBITDA on it, just so I can see it on a daily basis. Because I didn't know this word a few years ago. I think 2-3 years ago, it was I didn't know what the word meant. And we started getting a little bit bigger, and people started asking questions and asking, what is your EBITDA? I didn't know. So I had to, get the accountants to tell me what our EBITDA was, and then it became apparent that this is the most important kind of metric to kind of follow and grow, because it's what people are going to see and say and look at it and say, if they are going to purchase you, what is that? Because that a lot of the time they're going to have a multiple on that. on how profitable a business is. If a business isn't profitable, there's a whole other host of problems that comes with it. You can't grow, you don't have cash flow. It's like just petering along. A business has to be profitable so that it can invest in itself, invest in its people, and then grow from there. It's very, very important to know that any business that isn't profitable at the moment. But then again, Graham, a question that I actually have, a lot of these big companies that are valued at billions and billions of dollars haven't made profit. I mean, Uber just made a profit, I think it was last year. They've been going for like 12 odd years. They valued at billions of dollars, but they just don't make profit. So there's also that kind of thing where, do you need to be profitable to be valued high? I don't know. It's a good question.
So Renier, I mean, I'll jump in here now. I mean, but I think this is an important point, because I was waiting for the question, but the guys will say, yeah, but Uber or Airbnb, they've never made a profit. Why are they so valuable? Okay. There's a belief, investors believe that those businesses, that's called network businesses, they believe that they will get so big at a point that when they get to that point, like Google, they almost have a monopolistic position in some ways.
Yes.
Okay. And then they start printing cash. Okay. So I'm not going to go into all the technicalities of that, but there has to be a belief that those businesses can become profitable at a point in time. Okay.
Okay.
And I think that's really, really important. I think also for the most people that we're speaking to here, for most businesses, there are going to be the unicorns. But let's be blunt. It's 1 in 100, maybe 1 in 1,000 that kind of fall into those buckets. For the most part, for 95% of businesses, when we're talking about the fact that 85% of $2 to $20 million businesses can never sell, for the most part, forget about that. You might be onto the next Apple iPhone and then cool, have that discussion. For most business owners, that's a distraction. You're better off focusing on the basics and the principles. And the difference between a $2 million and a $5 million exit is life-changing. So I know I might kind of be bringing it back, but it's easy to get carried away in that hype. And even the media attention around that is disproportionate to the reality.
Of course.
So we want to change the core of the economies. Most economies are, what's the engine room of most economies is the SMB business space. And those are not the billion-dollar exits. Those are
100%.
the $2 to $20 to $50 million exits, which kind of
also a good note to have is those kind of businesses, you have a lot of VC money and media behind it, and they drive up the value for their investments to do well as well. So it's a whole media and PR play at the same time. But yes, it might take many years to get profitable, and they might be worth really a few billion. But as you say, it's definitely not the rule, but the exception. And it's not what, everyone in the room, we're running small to medium-sized businesses here. We need to make sure that, we focus on the things that matter, and make sure that we can actually, also control the things that we can control, which is quite important.
100%. Look, I think that's a whole other webinar at some point, which we can certainly set up. So I want to just touch on this briefly, and then I'm mindful of time and for some questions, but I want to just kind of segue a little bit into that from what you just raised here, is that we talk about high growth companies and traditional SMBs. And this table just kind of shows the principles around valuation are the same, but there are often some differences in terms of why evaluation needs to be done, things like risk, things like market size, revenue, and profit. And all this table shows is that the principles of understanding value, future profits, growth rates, and that differ. So, for high growth companies, often the reason you would want a valuation is for fundraising, strategic planning, if you've got a share scheme that you've incentivized your staff with. Traditional SMBs are more around exit planning or estate planning and structuring. So the reasons for valuations often differ. The risk is a big one that's different. So earlier stage companies, high growth companies, they may have more potential in terms of growth, but it's often higher risk. There's less of a track record. That's often why you'll find VCs will back founders who've found multiple companies, because they're actually backing the jockey. They're not backing the idea per se. They're backing the fact that this is a founder who's built 2 or 3 other businesses, so their chances of success, may be higher. Whereas a traditional business may or may not have been around for 20, 25 years. So there's a track record, it's a known quality. So, you might not get the astronomical valuation. There's more certainty, but by the same token, there's a high chance of you actually being able to exit. And the same goes to market size. So the big difference between a high growth company and a traditional SMB usually has to do with the degree of certainty around the assumptions that underpin that value. Okay, so that's all I want to say on that. And then I guess move on to this slide, which I think is probably, the really, really important slide. And as we've been chatting, I think we've touched on some of these things, but I like to think of valuation between what we call value drivers and value detractors. So the value drivers are those things on the left, they're the green ones that you can actively manage to increase value. The ones on the right, whilst you can manage them to increase value, they're often sort of almost seen as like hygiene. If you don't have them, it creates a problem. Okay, so what are the big things that really drive value? A strong growth rate, showing that you can grow not just 1 year, but consistently. Okay, so I think that's important. The cash conversion, we spoke about unit economics. How much profit are you actually, how much is your bank account actually growing by? Absolutely critical.
Yeah.
Things like IP and trade secrets, particularly when you're talking sort of knowledge economy type businesses and that, simple things like, is your web domain actually registered? Have you got defensive domains? Could somebody else come along tomorrow and kind of hijack your domain? It's happened. Even things like your trademark, have you been through, it's not a lot of money in the grander scheme of things, but if you've got a business, FTC, you guys have been through it, I know, have you actually registered your trademark, not just in South Africa, but in the markets that you're operating in? Those things are important because it prevents somebody else from just copy pasting what you've done and stealing your name.
Correct.
And then we spoke about recurring revenue and customer dependency. And then the last thing I want to touch on there is geographic footprint. Typically in today's world where you can deliver solutions and services remotely, digitally, I mean, look at this session today. We've got people from all over the world. Geographic footprint in a way that is smart and cost effective, and that is often a big value driver. People will look at businesses and say, can I take this model elsewhere in the world? So those are 6 things I think to look at.
Yeah, most
definitely. The detractors are the other things. Owner dependence. I don't need to repeat that, but I will. High customer dependency. It's the inverse of low customer dependency. I talk about cost to build versus buy. What I really mean about this is there a moat around your business? Can somebody else come in, take what you've done at a very low cost, build it differently, and then go and sell it? If it's a high cost to build, sometimes your business might be more valuable because it's cheaper to acquire the competitor, okay, or cheaper to acquire something that's already built. I want to talk about the 2 things which often seen as a hygiene factor, and I've seen deals collapse because of this, is inconsistent financial results and poor growth. Okay, so people will often look at and say, but I've had 2 years of great growth and great results, but it's up and down. What happened the year before? And so investors love certainty and they like consistent growth. So this sort of notion of feast or famine doesn't really go well in the investing world. So if you're building a business, think about how can you structure. You're going to have areas where you grow quickly and you need to kind of like juggle and build up capacity and that. But for the most part, think through the cycle, think longer term, and how do you build a more consistent track record? And the last thing, critically important, is your financial information, your bookkeeping, your taxes, all of those sorts of things. If you're ever thinking of selling your business and you're beyond a certain size, don't wait until a deal's on the table and then think, I need to get my accounts audited. It's too late. You might have to spend $10,000, $20,000 and having an audit done if you're beyond a certain size, but it's worth doing because, let's say a strategic buyer comes through the door tomorrow, you need to have that audit ready. You can't then scramble and take 6 months to get an audit done. So record keeping, absolutely critical. It's like, I'll use an example. I'm 22 years married, so I can't talk about that. But if you're dating somebody and it's great first date, great second date, and you go around to their house and it's just a mess, everything's lying around, you kind of, I'm sure my wife would have said, sure, I'm not marrying a slob. Fortunately that didn't happen. But those basics tell an investor a lot about how you run your business. So Renier, I'm going to kind of pause and then wrap up there. I don't know if you want to add anything before we do
So
a quick
I think that was
roundup
the first question that you guys asked us. Firstly, what accounting system are you using? And have you done your financials for the last few years? I think that was one of the first questions. We use Xero internally, and a lot of the attendees here will use Xero or Sage. And that's having an online system is fantastic, obviously, to track everything. If you aren't using an online system at the moment, it's definitely something to consider. And then I also want to touch upon the geographic footprint. Now, we in South Africa, even if you are doing product-based kind of stuff, the world is infinite. Like, we're only 1% of the world's GDP, right? If you're in a service-based business or in a tech business, you should be doing business with international clients. It should be your first market, honestly. South Africa is great and all, and we love living here, but doing business in South Africa there's a very small amount of fish to catch here, if you had to call it that. The international environment is something really to look at. So now that after COVID, everyone's very open to having Zooms and Teams, and you don't have to see each other all the time physically. It's broken that barrier down. You should be hunting and going and finding work offshore, regardless of the business that you're in. Yes, okay, if you're running a small coffee shop in Pinelands, it's not going to work, right? But if you are running a business that is selling product or an e-commerce store or service-based businesses, then international, you should be trying to get into those markets and going into that. And then I also think, just to touch upon the recurring revenue. When we first started, we were a digital agency, and majority of our work was project-based. It was going and finding these projects. But I really knew from then that you can't do that all the time. So building a company that has retainers or recurring kind of client base is key to long-term growth, because there isn't this feast and famine all the time. And I think that's also one thing that you guys highlighted, that if you have retainers in place and it's a sustained growth, then it's beautiful for even an investor to look at. But yeah, negatives, owner dependence, it's something that we're still figuring out. We're still going through that. It might take a few more years for me to actually really step away. Do I want to do that? I don't know. I actually don't know. It's something that I still love doing. I love selling. It's one of the things that gets me up. A lot of people are like, I would hate selling. It's like my worst nightmare. I love selling. I love being in the sales game. Graham, we've got one question before we go into it. Jeremy has asked, how would you value several entities owned by a few shareholders? Would you even do something like that, where you create a broad valuation, or would you do it per entity and then give that to them? How would you manage that?
Yeah, so I mean, I'd go back to first principles over there. Is typically, depending on what those entities are, but typically what you do is you'd look at each of the distinct quote unquote operating entities. You've got to cut through all the noise in that and saying, ask yourself, how is this business making money? And look at that entity, and there might be 3 or 4 of those. Okay, so ignore the shareholding for now. We value the business as a whole, or different components of the business. So if you've got a business, one that is selling bicycles, and you've got another part of the business, same shareholders, that's a coffee shop, you clearly can't value those two, lump them all together and value. So it's circumstantial. Is sometimes, if one is selling coffee beans and another one's selling tea leaves, and those are the two businesses, you might be able to lump them together because they're similar enough. So this is where the sort of professional judgment and understanding comes into the business. Typically, you would value the separate business units separately, add them up. And from a shareholder point of view, shareholder is an allocation of the value of the business. Okay, so I know there's discussions around things like minorities. If you're a minority discount and all of those sorts of things, that can get quite technical. But to keep things simple, is value the business as a whole. Okay, how that then gets divvied up between the shareholders is a little bit of a discussion, and often sometimes for negotiation between the shareholders. But if you've got an objective view of what the core asset is worth, then you can have that discussion. So we can take it offline, Jeremy. I mean, happy to jump on a call if for a more detailed answer. But that's kind of how we would look at it.
Graham, I've got a question. When should a business look at doing this? Is there a certain year that they should look at it, certain size, from an employee metric perspective or a revenue perspective? When is a good time for a business to actually look at this, to prepare, or just to understand where they are health-wise and that line in the sand kind of analogy.
Yes, I mean, I'll use an analogy on that. Like when should you start measuring your cholesterol and taking health seriously, for argument's sake? If you're a 2-year-old toddler, probably too soon. Okay. But if you're 18 years old or 16 years old, you're starting to get to that stage and there's a family history of high cholesterol in your family, you should do that. So I always say, principle-wise, you should start it sooner rather than later. So understanding the mindset and these principles, you should start from the day you build your business. You should be thinking around these different principles. In terms of valuing a business, I would say most businesses that are 3 years in is probably a good time to start having this discussion.
3 years in, yeah.
If you're earlier stage than that, you may well want to do a valuation. And to do evaluation, you need to understand what your forecasts and your plans are. If you're thinking about raising external money or seed funding or all of those sorts of things. So it could still be useful, but it's a slightly different context. But if you're using this to manage your business, probably from 3-4 years in, we would always advocate that this should be an annual checkup and an annual process. Now, again, because it's often on the important but not urgent, it doesn't happen. And I think also, just to touch on this, historically, valuation services and that have been incredibly expensive. So people have thought, oh, it's out of reach. I can't go and spend 250, 300,000 Rand or $20,000 at a big expert to do that. And that's part of what we've tried to do, is we've tried to bring the cost of this right down. And I kind of think, for the round of a 4-ball of golf or a nice meal out with some business partners, you can actually start to get a view in terms of what your business is worth. So the sooner the better. Any businesses at least 3-4 years old should be doing this at least once. And then also there's specific events that happen where you would want to do this. So if a shareholder wants to leave, if you're starting to think about life insurance and key man insurance for your business, really, what happens if something happens to you? What happens to the employees? Is there enough insurance to provide the money with the business sufficient money to keep going without you? It's a morbid topic, but you have to think about those things. So there's no right answer, bunch of different use cases, but the sooner the better.
I think 100%. If I knew of this kind of thing that I needed to do earlier, I would have done it earlier. But I think we did it this year. I've literally put it in as a budget line item every year that we're going to do evaluation at about Jan, Feb, once our financial year ends, and it gives us a good indication, because say in the next 5 years, there's a strategic purchaser that comes along and says, your business is perfect to align with us and we can 10x it with the clients that we have. So one of the times I'll potentially look at a sell. You already have that track record, that 3, 4, 5 years of this is how it was valued across the board, and this is where we are at a certain stage. So there is no kind of, this is what he or she could have said, whatever, but it's this track record goes into it. We've got a question from Anonymous. COVID had a negative impact on most businesses and many growth rates affected. Many are still trying to recover to get back to the growth rates, which is pre-COVID. Is there a kind of COVID effect, COVID area taken into account when valuing a business today? So if they had like 10 years of previous growth, now they're coming back, that little hiatus of non-growth, is that something you take into consideration, Graham?
Renier, absolutely. So what, and I'm not knocking it, but a lot of people do, and whether it's business brokers or when they value a business, and say, show us your last 5 years track record, take an average and put a multiplier on. Okay. And that's very dangerous to do. Okay. It's looking in the rearview mirror. Valuation by its nature is a forward-looking metric rather than a backward-looking metric. Okay. The fact that you played first team rugby at school or whatever the case might be doesn't necessarily, that's no real indication of whether you're going to play in the World Cup for the Springboks in the next World Cup. Okay. So COVID did have an impact. Some businesses, and you can probably attest to this, Renier, some businesses COVID absolutely transformed them. Okay. It forced them to make changes, and their growth rates have shot through the roof. Other businesses, the world changed, and they simply, whether you're in travel or tourism, some of those industries were heavily impacted. Okay, so there's no blanket approach. What we do is we look at where the business is now. Okay, we look at track record in terms of how did management and the team respond to changes, but more importantly, we look at what do we think the prospects look like going forward, and are those plans credible? What is achievable? And sometimes some businesses, the world's changed. They'll never get back to those valuations doing what they were doing. It might force them to say, look, if you want to get to that kind of level of value again, you've got to change how you're doing business. But it prompts those kind of conversations. So that's how we would look at it. And that's precisely, I've got the summary over here, and I say, this line 3 that says the valuation drivers are more important than the valuation itself. That's where I always go back to. You go back to a first principles approach and say, I often have guys who will say to me, but my exit number, I'm only going to retire if my business is worth $5 million. Okay. And you do a valuation and it's $2 million, and they throw their toys out the cot. No, you've got something wrong. Yeah. But when they make peace with the fact that actually, you know what do I need to do to get to $5 million? Then suddenly it's okay, you can't be growing at 10%, you need to be growing at 40%. Okay, what does that mean? How do I change it? And you get two types of owners. Some that will say, it's not worth the effort. I'm 65 now, I'll just take what I've got. And you'll get those who might say, I'm going to go for it and I'm going to execute that. Those are the clients that we love. Guys who actually look at this and say, I can do something about it. So I'm going back to that sort of COVID example. Whether it's COVID, whether it's anything else, whether it's a disruptive election, whether it's a war, whatever it is. Rear view mirror is useful, but forward view plans, what are you going to do, is more important. And that's why using this as a check going forward every year to kind of map your progress is actually really, really, really insightful.
No, fantastic. Great answer there, Graham. Quick question from Neil. How do intangible assets like customer loyalty or strong team affect the value of the business? Is that even a factor? I think that the team definitely, but do you actually speak to the customers of these businesses when you do these evaluations?
It's a great question. And there's, I'm going to answer it in two ways. One is there's some misconceptions around that. Okay. And secondly, absolutely, things like your customers, all that make a difference. So one of the things it's a very simple thing we look at. A lot of businesses will go and we'll have a look at what their Google rating is or their Trustpilot rating. Okay. Yeah. You see the numbers and there's a Trustpilot rating of 1.3 and you see that online store and they've got issues with refunds and returns and all of those sorts of things. So we actually do look at those things. But what these things all do is they point towards two things. They point towards, how people run their business. Okay. If you couldn't be bothered by the fact that you've got 300 one-star ratings on your thing, then I'm going to be a little bit skeptical as an investor as to what else are you kind of like brushing under the carpet. Okay. But at a principal level, those intangibles only have value because they have ability to create future profits. Okay. So people say, I've got 30,000 Instagram followers. It must be worth something. Yes, it's worth something if you can use those 30,000 Instagram followers to either sell something to somebody, leverage your brand. It comes down to that at the end of the day. It's pointless having 30,000 Instagram followers if you can't or not doing anything with that. I do want to touch on that very quickly because we always hear what we call a strategic buyer. And I have guys who say, but it doesn't matter because I'm going to get a strategic buyer who's going to buy me. They're not worried about the profits. They're just worried about my client base. It does happen. But again, like the unicorns, the strategic buyer it's like holding out for hope. Like you hope you're going to win the lottery ticket. In the place we operate in the small and medium business size, strategic buyers happen far less often than people would like to believe. Okay. And if your business is good for a financial buyer, it will more than likely be good for a strategic buyer as well.
Most definitely.
If it's good for a strategic buyer, it doesn't necessarily mean it's good for a financial buyer. So focus on the basics, because by doing that, you give yourself more optionality. If you've built a business and it's dependent on that one strategic buyer finding you, making you a good offer, and you getting your exit, to me, that's a very risky strategy to follow. So don't ignore the strategic stuff. I think I've gone on a bit of a tangent from the question, but hopefully it all pulls together.
No, fantastic. I think the key here really is to build a business that can be sold, but even if you're not going to sell it, because then everything is in place, your profits in place, your processes, your owner dependency is not there. Making sure that it is at a healthy level that you as an owner can then do certain things, because you know, with a lot of entrepreneurs, optionality, a lot of entrepreneurs do get to a stage where they need something else, another project, or, you know, that does happen, and making sure that these businesses can function without the actual founder. It might take a few years, might take a decade, but it's very important to get to that stage where it's working and running by itself. That flywheel's been created, the momentum is there, and your processes can manage any kind of challenge or hurdle that comes along. I think that's one of the key things. And, you know, I'm not sure, I don't think there's any other questions, but Graham, the key thing for me as a business, right? It's like growing this, it's like growing a crop, right? And you coming in, having a look at the soil quality and the nutrition that goes into it. Is it right? Maybe we should do it differently. Maybe we should, you know, put you on the treadmill a little bit more, or get you a different fertilizer. I don't know. It's like that kind of check that comes in and says, right, guys, you aren't doing this correctly. I mean, just from the evaluation I did in the beginning of the year, we've increased our prices because of that unit economics conversation we had. Guys, you probably aren't charging enough where you should be at a certain level. And that's
so when your clients on the webinar, they're going to come and take shots at me now.
I'm talking about, but then also, you know, with that, you have to obviously justify. So changing process and value, right? Right, we have one more question from Brendan. How does business lending funding affect the business evaluation? So if they've lended, or if there's been funding in it, does that affect it quite a bit? I think this is the last question, guys, from my time side.
Yeah. So very briefly, we value the business as a whole. Okay.
Yeah.
And then if there's any external debt, lending or loans or whatever, let's say the value of the business as an operating entity is 100 million, and there's 10 million of debt. Yeah, you would then take the 100 million less the 10 million, and 90 is obviously due to the shareholders of the business. So we do take that into account. I think what's important there is that, so that's a whole discussion around leverage and how you can actually use debt to grow your business and actually create value. That's a whole separate discussion. But the short story is, yes, you deduct debt from the valuation, but also if that debt is being deployed productively. So if you're taking a loan so that you can improve your shop front, so that more people come and they actually increase your growth rate, taking on debt can sometimes actually increase the value of your business. And I'm keeping it very simple, but Brendan, happy to, if you want to drop me a mail or take it offline, happy to have a more detailed response on that. I'm just mindful of time now.
That's it. Guys, appreciate you being here. We are going to send you an email afterwards with everything. Also, you know, if you want to go connect with Graham, he's been gracious enough that if you mention FTC, they'll provide you with a small discount on your next valuation. It's been absolutely invaluable to us. We're going to be doing it once a year. It's not expensive. It really helps us. And just looking at the questions being asked and then looking at the answers, what we can do in the year is exceptionally valuable for founder or business owner. And thank you very much. Graham, your time's been awesome here. Thank you. Appreciate it. You've given us some great golden nuggets to go on, and appreciate all the attendees being here. Thank you, everyone. And we'll chat to you quite soon. And yes, if you want to visit BizVal, you're welcome to go and take a picture of this. We will send an email with the links as well and the recording of the session. Fantastic, Graham.
Fantastic, Renier. Thanks for having me. And to everyone who's dialed in, appreciate it. And anyone who's listening on recording, thank you. And hope to chat again soon.
Fantastic. Excellent. Cheers,